Good morning. This is Dylan Jovine behind the markets. Happy Monday. Today is Monday, May the 4th. May the 4th be with you. For those of you like me, nerds who celebrate that little ridiculous self-made holiday. Anyway, today I'd like to talk about one of my favorite things to talk about, honestly. And I talk about it, for those of you who've been watching this for years, know that I talk about this once every, 3 months, but I really have to do it again. Really, it's like one of the top investing blunders that people make at any age, whether you're 30, whether you're 40, whether you're 50, whether you're 60, whether you're 70, whether you're 80. I see people of all ages making this mistake all the time, and it really blows my mind. So I feel I have a responsibility to bring this up and ring the bell once every few months. So anyway, on Wednesday, the Federal Reserve kept rates basically steady, 3.5 to 3.75. And basically, the Fed rate basically drives yields on products, lots of products, savings accounts, CDs, short-term T-bills, money market funds, et cetera, a whole bunch of things. But Fed funds have stayed steady. The Federal Reserve kept it steady. But guess what? That's not the way private companies do things. They can ignore that if they want. So literally, in days, basically, a few companies, let's see here, Capital One, Synchrony Financial, Marcus by Goldman Sachs, and Ally Financial recently have dropped the APYs on their high yield savings accounts anyway. So Fed keeps the same, these guys pay you less. Isn't that interesting? It used to be that bank savings accounts mimicked what the Fed did. The Fed raised rates, they raised rates in lockstep. When the Fed lowered rates, they lowered rates that they paid you for your savings accounts, et cetera, in lockstep. It's not like that anymore. And I see lots of folks that make the mistake of keeping their money in a savings account. That's a fake word. It's a fake name. It's a marketing name, a savings account. They're not paying you for that. It doesn't mean what it used to mean when we were growing up, okay? Maybe it still applies in the sense that you put your money there and you try to save for something, but it's not a savings. You're not really paid. Think about it. Those were high yield accounts that I just mentioned. But Bank of America pays 0.01%. Citibank pays 0.18%. JPMorgan pays 0.01%. Actually, you can see Bank of America and JPMorgan pay 0.01%. That's because they're really healthy banks. Citibank is paying 0.18% because they're looking for business. And that matters, especially when you're dealing with large sums. These are all money center banks. My point is, inflation is at least 3%. So think about it. For every $100 you have in a savings account by the end of the year, it's worth 97 bucks. Now, Bank of America will add a penny to that, 97.01. It's crazy. It's absolutely crazy. You need to keep your money in something that at least grows at the inflation rate while you hunt for good opportunities as an investor. This is how I do it. And I recommend, and I've recommended this a dozen times here on this channel, but Schwab Treasury Money Market Fund, the symbol is SNOXX. Sam, Nancy, Oscar, X-ray. Schwab Treasury Money Market Fund. It pays 3.4%. I am not paid by Schwab to say this at all. But this is what I tell my friends to do, and this is what I do myself. And these guys pay 3.4%, and this is a short-term Treasury money market fund, meaning they take your money and they only invest it in short-term, under a year, things like T-bills, Treasury bills, only Treasury money market funds. So it's really buying from the U.S. government with short durations, which means, remember something, duration is time. The longer the duration, the more volatile a bond becomes. So these are short duration. They mature in 30 days, 60 days, 90 days. So you don't have really risk, not really, of it breaking $1, right? And it pays dividends. It pays the income monthly. It's designed to pay you monthly, which is great. So I urge everybody to take your money out of a bank. It doesn't have to be a Schwab. Who cares? I don't care. I don't have a horse in the race. But you want to invest your money in a short-term U.S. Treasury money market fund. Now, what are the risks? It's literally government debt, so it's actually safer than a bank, okay? The banks are backed by government. So this is the ultimate government debt. So in terms of risk, it is technically lower than a bank. It's U.S. government debt, short-term U.S. government debt. If you don't broker at Schwab, find the alternative. Find one at your brokerage firm. Everybody has a product like this. They're all over the place. It's a no-brainer. And look, at least you'll match the inflation rate. You won't lose money. So that $100 that turns into $97 and a penny, let's not forget Bank of America's generous contribution, that $97 and a penny, at the end of the year, you would have $103.40. That really adds up over time, guys. Or, assuming inflation, you would have at least $100 at the end of the year. So instead of your money, you always watch these movies about these old timers who stash $1 million underneath the rock. $1 million a lot of money. They stash 100 grand, then they come out of prison 30 years later and they find it. I got news for you. 100 grand wasn't what it was worth 40, 50 years ago, okay? So look, this will go down. It's the one thing I wish we had a Federal Reserve that didn't allow for 2% inflation, even though we're higher than that. I wish we had a Federal Reserve and a government that didn't allow for any currency depreciation, but we don't. So you have to, at a very bare minimum, recognize and plan for currency depreciation, which is why I would go with something like SNOXX. Anyway, I'm done lecturing. I don't want to sound like your grandmother or grandfather or cranky grandfather, but that's what you should do. Anyway, have a great day. I'll see you tomorrow.